In engineering, a counterweight isolates downward force from an upward trajectory. Financial markets use similar mechanisms to separate downside risk from upside potential. That mechanism is the option. Options are derivatives that engineer asymmetric risk by granting the buyer a right, but no obligation, to buy or sell an asset at a pre-agreed strike price on or before a specific expiry date. We define asymmetry with two payoff functions, call and put. The call stays 0 below strike, then rises 1 to 1. The put works in reverse, rising as the asset falls. We model this using 4 variables: final price, strike price, call premium, put premium. Understanding this mathematical asymmetry is the starting point for pricing and managing risk at an institutional scale. A common error in derivative analysis is treating the payoff at expiry as the actual realized profit. Let's look at a European call option with a strike of 50 and an upfront premium of $4. The intrinsic payoff remains 0 until the asset price crosses the strike. But because we paid for this contract, we must deduct the $4 premium from the entire function. This shifts the line downward, revealing our actual profit and loss. This creates a break-even price at exactly 54. The asset must reach this level just to recover the initial cost of the option. If the final price is 58, the intrinsic payoff is $8, but once you subtract the premium, the realized profit is 4. If the asset falls to 45, the payoff is 0. Because the option is never exercised when it's out of the money, the maximum loss is strictly limited to the $4 paid up front. The seller of this option faces the opposite profile. Their maximum gain is capped at the $4 they collected, but they are exposed to the full upward move of the asset. The premium is the specific price a buyer pays to truncate their downside risk, while keeping the path to upside gains open. We categorize an option's state using moneyness. Contracts are either in the money, which have intrinsic value, or at the money and out of the money, which have none. This premium is composed of 2 parts, intrinsic value and time value. As the expiry date nears, time decay erodes the premium. At the moment of expiry, the time value is 0, and the premium equals the intrinsic value. Time value represents the market's calculation of the probability that the option will move further into the money before it expires. Volatility is the other key driver. It widens the range of possible outcomes for the underlying asset. Because an option's downside is capped at 0, higher volatility benefits the holder. It increases the chance of a significant move into the money without increasing the risk of a larger loss. While European options can only be exercised at expiry, American options can be exercised at any time, which adds to their market value. Even so, early exercise of an American call is usually suboptimal. Selling the option generally yields more than exercising it, as exercising destroys the remaining time value. The main exception is to capture a large dividend. American puts are different. If a put is deep in the money, it can be optimal to exercise early to capture the interest on the cash received from the strike price immediately. Time and volatility are not abstract ideas, they are specific components of the premium. Traders can use these relationships to create synthetic positions by borrowing the present value of the strike price. Suppose we have a $100 stock and a $100 strike. Interest is at 5%. We have 1 year to expiry, and the call is trading at $10. To find the fair put price, we start with our $10 call and subtract the $100 stock. Then we add back the strike price, discounted at 5%, which is $95.12. This means the put must be priced at $5.12 to maintain equilibrium. If the market suddenly quotes that put at $6.50, it is overpriced relative to the other variables. This creates an imbalance in the parity equation, signaling an arbitrage opportunity. To exploit this, we sell the overpriced put for $6.50 and short the stock for $100. We then use that cash to buy the call for $10 and invest the rest at the risk-free rate. By the time the contracts expire, we will have a riskless profit of 1.38, regardless of where the stock price ends up. Put-call parity is a structural identity in the market. When it is violated, arbitrageurs act quickly to trade the prices back into alignment. By strategically combining these contracts, we can engineer specific market positions that are not possible with stocks alone. Consider the bull-call spread, a strategy used to reduce the cost of an initial position. We start by buying a call at a lower strike price. To offset the cost of that premium, we simultaneously sell a call at a higher strike price. The net payoff is this Z-shaped structure. It has a clearly defined floor for the maximum loss and a ceiling for the maximum profit. This reduces our capital requirement, but in exchange, we give up any gains if the stock moves past our second strike. Another strategy, the straddle, is used when a trader expects a large move but isn't sure of the direction. A straddle is built by buying both a call and a put at the exact same strike price. This creates a V-shaped profit profile. The position loses money if the stock stays quiet, but profits if it moves significantly in either direction. The straddle isolates volatility. It allows a trader to bet on the intensity of price movement rather than the direction. Ultimately, options are mathematical tools that allow investors to isolate, price, and reallocate financial risk across the broader markets.